What if you could invest in a hurricane or an earthquake? It sounds strange, maybe even a little macabre. But what if that investment helped communities recover from devastation? And what if it also offered financial returns completely disconnected from the chaos of the stock market? This isn't science fiction. It's the world of catastrophe bonds, one of the most fascinating and important corners of modern finance. Welcome to G Fun Facts Online. Today, we're diving into the economics of disaster. When a massive hurricane, earthquake, or wildfire strikes, the human cost is immeasurable. But the financial cost is staggering, often running into the tens or even hundreds of billions of dollars. Insurance companies are on the front lines, paying out claims to help people rebuild their homes and businesses. But sometimes, a single event is so large it could bankrupt even the biggest insurer. For decades, the solution was something called reinsurance. This is basically insurance for insurance companies. An insurer pays a premium to a reinsurer, who agrees to cover a portion of their losses if a major disaster occurs. It's a way to spread the risk. But as climate change makes extreme weather events more frequent and more severe, the traditional reinsurance market is being stretched to its limits. The potential losses are becoming too big for even the reinsurance industry to handle alone. So in the mid-1990s, after a string of massive losses from events like Hurricane Andrew, financial innovators asked a powerful question. What if we could take this massive risk and transfer it to the deepest pool of money in the world, the global capital markets? And thus, the catastrophe bond, or cat bond, was born. So what exactly is a cat bond? At its core, it's a financial instrument that allows an insurer, or even a government, to pass on the risk of a specific, predefined disaster to investors. In exchange for taking on this risk, investors receive a high rate of interest. If the disaster doesn't happen, the investors get their money back at the end of the bond's term, plus all the interest payments they collected along the way. But if the specific catastrophe does occur and meets certain conditions, the investors lose some or all of their initial investment. That money is then used by the insurer to pay claims. To understand how this works, we need to follow the money. Let's say an insurance company, well, call it Safe Harbor Insurance, is worried about its exposure to Florida hurricanes. They want to offload $1 billion of that risk. First, they can't just issue the bond themselves. For legal and financial reasons, they need a separate bankruptcy-proof entity. So they help create something called a special purpose vehicle, or SPV. Think of an SPV as a locked box, a company created for one single purpose, to issue this cat bond. These SPVs are almost always set up in places like Bermuda or the Cayman Islands. This isn't for shady reasons. It's because these jurisdictions have developed very specific, efficient legal and regulatory frameworks for these types of transactions. They are tax neutral, meaning the SPV itself isn't taxed, which allows for a cleaner flow of money between the insurer and the investors. They have decades of expertise in this niche field. In fact, Bermuda is the undisputed world leader, with the Bermuda Monetary Authority overseeing a market that continues to be dominated by new cat bond and insurance-linked security registrations year after year. Once the SPV is established, it issues $1 billion worth of catastrophe bonds to the market. These aren't typically sold to the general public. They fall under a U.S. regulation known as Rule 144A, which means they are sold to qualified institutional buyers. These are the big players: pension funds, hedge funds, specialized investment funds, and asset managers who have the sophistication to understand these complex instruments. These investors give their $1 billion to the SPV. The SPV doesn't just hold this cash. It puts that $1 billion, the principal, into a collateral account and invests it in ultra-safe assets like U.S. Treasury bills. This ensures the money is secure and earns a small amount of interest on its own. Now, the insurer, Safe Harbor, starts making regular payments to the SPV. These are essentially their insurance premiums. The SPV takes these premium payments from Safe Harbor, adds them to the interest it's earning on the collateral, and uses this combined pot of money to pay a high interest rate or coupon to the bond investors. This is the reward for the investors. They receive these attractive quarterly or semi-annual payments for the entire term of the bond, which is typically 3 to 5 years. So for 3 years, everyone is happy. Safe Harbor has its risk covered, and the investors are collecting high yields. But what happens if the feared event occurs? This is where the trigger comes in. Every cat bond has a very specific, legally binding trigger mechanism defined in the contract. If this trigger is activated, the investors lose their money. There are a few main types of triggers. The first is an indemnity trigger. This is tied directly to the sponsoring insurer's actual losses. For example, the bond might trigger if Safe Harbor's claims from a single Florida hurricane exceed $5 billion. Once their losses hit that mark, the $1 billion in the SPV is released to Safe Harbor to help them pay the rest of their claims. The second type is an industry loss trigger. Instead of being tied to one company's losses, this trigger is based on the total insured losses for the entire industry in a specific region, as calculated by an independent third-party data firm. For instance, the bond might trigger if a California earthquake causes more than $20 billion in total insured losses across the entire state. This avoids any conflict of interest related to how the sponsoring insurer adjusts its own claims. The third, and perhaps most straightforward, is a parametric trigger. This trigger isn't based on financial losses at all, but on the physical characteristics of the event itself. A hurricane bond might trigger if a storm of Category 4 or higher, with wind speeds above 130 miles per hour, makes landfall within a specific geographic box. An earthquake bond might trigger if a quake of magnitude 7.0 or greater occurs at a certain depth within a defined zone. The data comes from an objective, official source like the National Hurricane Center or the U.S. Geological Survey. If the trigger parameters are met, the bond pays out automatically, regardless of the actual financial damage. This provides very fast payment, which can be crucial for governments or organizations needing immediate liquidity after a disaster. If any of these triggers are hit, the investor's principal, that $1 billion sitting in the collateral account, is paid out to the insurer. The investors lose their money. If the bond's term ends and no trigger event has occurred, the SPV returns the full $1 billion principal to the investors. They walk away with their original investment back, plus all the handsome interest payments they collected along the way. So why on earth would an investor sign up for this? Why risk losing everything based on the weather? The answer comes down to two powerful words: yield and diversification. First, yield. Cat bonds offer significantly higher interest rates than most other fixed-income investments of similar credit quality. Investors are being paid a premium to take on a risk that few others are willing to take. For a fund manager looking to boost returns, this can be very attractive. But the second reason is far more important: diversification. The performance of a cat bond has virtually zero correlation with the performance of traditional financial markets. Think about it. A major stock market crash doesn't cause an earthquake. A rise in interest rates doesn't create a hurricane. A global recession doesn't trigger a wildfire. The events that cause a cat bond to default are completely independent of the economic cycles that govern stocks and traditional bonds. This is the holy grail for large-scale investors. In a world where global markets are increasingly interconnected, finding a true diversifier is incredibly valuable. Adding cat bonds to a large portfolio can lower its overall volatility and risk, because when stocks are crashing, your cat bonds are likely still paying out their interest, as long as a super catastrophe hasn't occurred. This unique feature has fueled the market's growth, pushing it from a niche concept in the 90s to an established asset class approaching a market size of $50 billion today. The market has proven its resilience, surviving major loss events and continuing to attract capital. Of course, the market is not without its challenges and concerns. One potential issue is called moral hazard. This is the concern that a sponsoring insurer, knowing that a big chunk of their losses will be passed on to bondholders, might become less rigorous in their claims adjustment process. They might be tempted to approve claims more easily to reach the trigger point faster. However, the market has structures to mitigate this. As we discussed, industry loss and parametric triggers are not tied to the insurer's own behavior. And even for indemnity bonds, the process is subject to intense scrutiny, with independent verification and auditing built into the bond's legal structure to ensure the reported losses are legitimate. The other major challenge is modeling the risk itself. How do you accurately price the probability of a 1-in-100-year storm? This is the job of specialized risk modeling agencies, which use complex computer simulations and historical data to estimate potential losses. But climate change is a massive curveball. Historical data is becoming a less reliable guide to the future. Storms are becoming stronger, wildfires more widespread, and flooding more common. Modeling agencies are in a constant race to update their models to reflect this new reality, incorporating the latest climate science to provide the most accurate risk assessments possible. The future of this vital market stands at a critical juncture. Its role as a financial shock absorber is more important than ever in an era of increasing climate-related disasters. Regulators are also paying close attention. In Europe, for example, there's an ongoing discussion around the UCITS framework, which governs funds sold to retail investors. The European Securities and Markets Authority, or ESMA, has raised questions about whether complex instruments like cat bonds are suitable for these types of funds, suggesting they might be better placed in frameworks for more sophisticated investors. These regulatory refinements will continue to shape how and where cat bonds can be sold. The market is also expanding beyond what we call nat cat, or natural catastrophe risk. We are seeing the growth of bonds covering more esoteric risks, like cyber attacks, pandemics, or even operational risks for large corporations. The underlying principle is the same: transfer a specific, low-probability, high-impact risk to capital market investors who are willing to be compensated for taking it on. For the insurers, governments, and corporations on the front lines, catastrophe bonds offer a powerful mechanism to build financial resilience against the unimaginable. For investors, they provide a unique source of high, uncorrelated returns in an increasingly interconnected world. By bridging the gap between the immense need for disaster capital and the vast resources of the global financial markets, the economics of catastrophe bonds are fundamentally changing how we manage, mitigate, and survive our planet's most formidable challenges. It's a fascinating intersection of finance, science, and public policy, working to create stability in a world that feels anything but.